Ryan from Limerick Chamber, and on behalf of the team at Limerick Chamber, I'd like to warmly welcome you to today's webinar, which is designed to be of support to you as you think about your organisation's liquidity. I'd like to thank sincerely the team from Deloitte and Limerick for their time today, and indeed for their time in preparing for today's session, which has been greatly anticipated. We're really looking forward to getting some practical tips and some good suggestions for you. I know that in talking to business owners and CEOs around the region that there is a huge amount of cash flow anxiety out there. So we're really grateful to you for your time today and for your expertise on how tax can be used as a factor to mitigate cash flow and anxiety. Okay, thank you very much. I'm going to hand over to Karen.
Thanks, Dee, and hello, everyone. Thanks for joining us on this sunny afternoon. We appreciate it. I suppose to start off, like any good consultants, we've, I suppose, been doing a lot of work around how we respond to the current crisis. And in particular, we've split, I suppose, how businesses look at the crisis into three phases. The first one being the respond phase, which is probably where most of us are now, where we're scrambling just to deal with the interruption to business. The next phase we'd look at is recover, where I think slowly most of us are moving to at the moment in just standing up business back up again, looking at, you know, how things are going to slowly move towards a new norm. And then the last phase that we all hope to get to is the thrive phase. So that's where we're looking at all getting back to not necessarily normal, but I think we'll all accept when we get there and everyone's back up on their feet that there will be a new normal of sorts. And we've been working with clients in a number of different areas, but one of the ones that's probably the most pressing and most of interest to clients is around business continuity, and in particular how they manage their cash flow. And one of the sectors of that we've been looking at is, well, from a tax perspective, are there quick wins or easy things you can look at or do to manage without any kind of aggressive tax planning or detailed structuring or cost? Are there easy ways that you can look at managing your tax returns, your tax payments, or even how you invoice just to ease cash flow pressures, or indeed in some cases to accelerate cash? So we're going to have Jane talking around indirect taxes, Fergal around corporate tax, and Carmel around employment taxes. We will take some time for questions at the end, so feel free to put them on the chat function on Zoom. And then equally, we do have more collateral which we can circulate to this group with more detail on some of the ideas that we've discussed afterwards. So with that, I'll hand over to Jane.
Thank you very much, Karen, and good afternoon, everybody. I'm going to spend the next few minutes just chatting through some of the VAT ways that you can hopefully maximise your cash flow in these pretty challenging times. I guess we're just going to start with by looking at the COVID measures around indirect tax. And I guess as most of you will know that the Irish Revenue have given measures for SMEs. And they're allowing SMEs to defer their VAT payments for the January-February period, and now also for the March-April period until a point in time in the future. Now, I don't know when that deferral is until. We're waiting for Revenue to come back to us on that, but we do expect there'll be something by the 23rd of May on that point. And I guess it's worth mentioning what an SME is in the context of, in an Irish context. So the Irish Revenue believe it's a company with a turnover of less than €3 million, who is not dealt with by Large Cases Division or by the Medium Enterprises Division. And as you'll all know, there's COVID measures across the EU and beyond, and we have a really low bar as to what we define as an SME, and a lot of the measures globally are targeted as SMEs. And if we look to our EU counterparts, so they look at an SME as an entity with a turnover of less than 50 million or less than 250 employees. So if you have operations across the EU or beyond, you know, just because I would say that So sorry, if you have operations in the EU and you're not an SME, that doesn't mean you are not an SME in an EU context. So certainly look to the rules in other countries as opposed to just relying on what an SME is here in Ireland. In an Irish context, if you're not an SME, it's still worth approaching revenue if you're having difficulty in making those VAT payments. What we're finding with our clients is they are delaying the payment, but they're doing it period by period. But it's certainly worth liaising with revenue and discussing it if you are having difficulty paying your VAT at this point in time. I guess just look to our nearest neighbour, the UK. They've been extremely generous. They are allowing the deferral of VAT payments until the end of their tax year, which is actually next year, April 21 in some circumstances. So if you've operations in the UK and you owe VAT there, certainly we're looking at the release for you there. For those of you supplying goods or services in the, to directly fight COVID-19, there's both customs and VAT relief. I won't go into them now because it really only affects a small amount of businesses, but it is worth looking into if you're within that remit. I guess now to move on to non-COVID measures, and these are measures that you can take at any point in time to inject some cash into your business. And I guess the first one is around your purchase invoices. And the easiest way to explain this is to maybe look at your March, April VAT return. And at the moment, when most companies are trying to file their March, April VAT return or any VAT return, they pull a report from their accounting system and they will look to, and that accounting system will typically have a month-end close. And that close date could be today, which is the last Friday of the month, or equally it could be the 30th at the end of the month. Regardless, you will probably receive invoices dated in April, but you'll receive them in May, and they won't form part of that report on which you're basing your VAT return. And you can do an exercise to look at all of the purchases invoices you receive after month-end close-off date, and you can put them into your March, April VAT return and get the benefit of that VAT when you file by the 23rd of March. So that certainly helps in pulling back some of the VAT. And then obviously on an ongoing basis, you have to continue to make that adjustment. So it's a one-off cash flow injection into the business. On the other side of the house, be it your sales invoices, a lot of companies will be striving to issue invoices by the month end, by the 30th of April. But when you issue an invoice for the 30th of April, the VAT will be due by the 23rd of May, which is only 3 weeks away. If you delayed raising those invoices until the 1st or 2nd of May, which really is only a few days, then you have until the 23rd of July to make that VAT payment in your May-June VAT return. So that's another quick win if you want to try and inject some cash flow into the business. I guess unfortunately, all businesses will suffer from bad debts, and now is an opportune time to look at your the debts being owed to you. And you can claim the bad debt relief if you've taken reasonable steps. And if we look to what those reasonable steps are, so have you had correspondence with the debtor? Have you referred the issue to a solicitor? Or have you taken any other actions to try and recover that debt? And if you have, and you do have to write it off in your financial statements, but you can claim a relief for that bad debt in your current VAT return period. Something we often do with clients is around accounts payable reviews, and you'd be surprised how much VAT isn't recovered. And what we find is, for some reason, invoices can be posted gross and the VAT isn't separated out, so you can then miss that opportunity to claim that VAT back. You can have situations where your VAT is incorrectly coded to irrecoverable VAT. Again, you miss the opportunity there. If you look at your company credit cards or indeed petty cash, very often the processes haven't been put in place, or there's just a general acceptance in the business that VAT cannot be recovered if it's been paid for via petty cash or credit cards. But if you have invoices to support that, then that VAT can be recovered going back 4 years. So it's certainly worth looking at your those credit cards, the petty cash that may not be going through your traditional ledgers, to see if there's any possibility of deducting VAT there. Then just to mention, we often find non-Irish VAT within the accounts payable. A non-Irish VAT can't be deducted via the Irish VAT return, but you can do what's known as an electronic VAT refund or an EVR claim. And I guess in the past, they were very difficult to administer, but that certainly has become easier in recent years. And something to add to that, very often companies will incur VAT on staff accommodation or expenses in other jurisdictions. And our bar here in Ireland to claim the VAT back on staff expenses, accommodation, food, drink is very challenging, and in general it's quite limited. But the same can't be said for the rest of the EU. And there actually is we do a guide each year that you can get. It's freely available on the internet. We can certainly send it around, and that gives a detail as to what VAT can be incurred in the various jurisdictions. And you'd be surprised the amount of VAT that is recoverable, but that you may not be recovering to date. Just to move on, I guess, to the area of request for payments. And if you provide a continuous service, so professional services firms or even landlords providing the services to the tenants, so any continuing service that can be provided, the tax point is triggered by either the issuing of the VAT invoice or indeed when you receive payment. So instead of issuing a VAT invoice, if you issue a request for payment, you will defer the tax point until you actually receive the payment, and at that point you can then issue the VAT invoice. Just on that one, be a little bit careful. You do have to look at the T's and C's to make sure that you can do that, and also you may need to discuss with your customers, as it will delay when they can deduct the VAT on that. But it can be one that can be very useful, especially in the current times, to delay the payment of VAT. And I guess the last area I'll just touch upon is around customs, and not to mention the big B word, Brexit, but unfortunately I think it is coming. So we'll all know that the transition phase is over at the end of this year, 31 December. The UK have until the 30th of June to decide if they want to extend that by either 1 or 2 years. What we're hearing on the ground is that it won't be extended, which means that come 1 January, we will have customs between the UK and Ireland. Now, whether that's a border on the Irish seas or within Ireland, I don't know yet, so that remains to be seen. But there are customs reliefs, and they do take some time to put in place, and they can either delay the payment of the customs, or in some instances they can negate them totally. So, for example, with inward processing relief, where you would have goods coming in from the UK, processed here, and sent back out to the UK. So the reliefs that are certainly worth looking at, but they can take a number of months to put in place. So, for example, IPR can take 3, 4, 5 months to put in place, and with COVID-19 that could take even longer. So it's worth looking at those now, and in long term, to see if you can reduce the cash tied up within customs or VAT going forward. Thanks all. I'll be very happy to take questions at the end, but for now I'll pass you on to Fergal. Thank you.
Thank you very much, Jane. I'm going to move matters to corporation tax and actions that taxpayers can take to accelerate cash flows in this current environment. By way of overview, I'm going to look at 3 particular areas: the management and payment of corporation tax, and utilising trade losses, maximising tax reliefs and tax credits, and briefly I'm going to touch on some worldwide measures in the space of COVID-19 specific to tax. So, starting with the payment of corporation tax, one must appreciate there are specific preliminary tax payment rules. Broadly speaking, a company is either a large company or a small company for preliminary tax purposes, with last year's final corporation tax liability being the deciding criteria. Where that liability is greater than 200,000, the company is a large company, and where it's less than 200,000, it's a small company. However, and importantly, in both data sets of rules, there is an option to base your payment on the current year liability or prior year liability. Now, it's fair to say in a lot of instances, taxpayers default to the prior year liability because it's a known amount, it avoids estimation, and therefore reduces the exposure to interest. However, given current circumstances and likely decreasing profit levels, one must really consider should they look at a current year method to calculate their preliminary tax. The smart play here would be to run a calculation to determine or estimate what that liability is. The key point here is don't leave monies with the revenue commissioners where there's no obvious requirement to do so. Given the importance of this and the impact this can have, on my next slide I'll just run through a quick example. The next point is to appreciate the value of corporation tax losses and particular refund provisions. From a cash perspective, corporate tax losses can be set sideways in the current year against other streams of income, for example, investment income and rental income, and this can reduce current year tax liabilities. Furthermore, losses can be carried back to the preceding accounting period, and this is a direct access to a tax refund in that prior year. Just in a word of note, where you claim the loss in the current year, there is also a requirement to make an amended tax return in that prior year. Now, we appreciate there can be habits built up over a lifetime of business where tax returns are typically filed around the deadline day. Our message here would be to structure your affairs to early file, get your refund on record, and then engage with revenue to access that refund. Now, heretofore, it's fair to say that tax refunds are often used by revenue to intervene or query wider matters in one's affairs, but we understand from revenue during the period of the pandemic, there will be somewhere between a no touch to light touch by revenue when considering these tax refunds. Two other points in the space of losses. There may be certain instances where taxpayers would wish to change their accounting period. The smart play here might be to crystallize losses earlier and trigger or pursue the utilization of those losses in current or prior periods. Equally, and unfortunately, there may be businesses which do not survive the current circumstances, and current loss utilization provisions may be of little use. However, there is a concept known as terminal loss relief for businesses that do not survive that extends the carryback period of losses from 1 year to 3 years, which is a potential route to access cash. Moving on in terms of governance, the key message would be, to the extent possible, continue to file your tax returns on time. This is probably best captured where revenue have gone to print to say that where in that chain of personnel required to file a return, there is blockages arising from COVID-19, proceed on a best estimate basis. Now, in the tax realm, this is rare, but it captures the importance of getting your tax return filed on time. For taxpayers who don't file on time, revenue have said they will not deploy their typical weaponry, such as a late filing surcharge as high as 10% on your corporation tax liability, or restriction of loss relief or group relief. So while they're welcome measures, it's probably something you can avoid by filing on time. Just note that these provisions only apply for accounting periods ending 30th of June 2019 and onwards. Moving on to matters of debt management, these are overseen by the Office of the Collector General, and it's likely that many taxpayers arising from tax arrears will find themselves requiring a phased payment arrangement. Now, a phased payment arrangement in theory is a facility offered by the Collector General to grant the taxpayer a period of time to bring their affairs back on a firm footing. We expect a surge in these applications, and in light of that, I will pick up some further detail on that in a later slide. Lastly, in terms of professional services withholding tax, this is a withholding tax deducted by state and semi-state bodies. It's 20% of the invoiced amount, which is significant and often a key ingredient in managing one's tax affairs. There are certain provisions in relation to interim refunds of professional services withholding tax deducted, for example, in the space of particular hardship or startup situations. What Revenue have said that they will facilitate and accelerate professional services withholding tax claims, even where a site of the original F45, which is the deduction certificate, is not furnished. That's a very much a welcome measure by Revenue. Equally, there is a further fallback provision where a taxpayer cannot get their hands on the original F45 by virtue of blockage at the state or semi-state body end. Where they're furnished with a document containing all the relevant information, Revenue have outlined they will work with those taxpayers. Just circling back to my example on preliminary tax, what I have here is a situation of a company with a June year end. It's filed its June 2019 corporation tax return and has a final tax liability of €108,000. In this case, it's a small company, and it has two choices in terms of addressing its preliminary tax for the current year, which is the 30th of June 2020. That preliminary tax payment is due 1 month before year end on the 23rd of May. Its two choices are pay 100% of the prior year liability, which we'll see is another payment of €180,000 on account for FY20. However, let's assume there's a 25% reduction in turnover and profitability, and the best estimate of the corporation tax liability is €135,000. The second option for preliminary tax is to pay 90% of this figure. That's a payment of circa €121,000. So the key message here is, assuming everything is filed when it was due, there is a differential of €60,000 tied up with revenue for a 10-month period, plus the amount of time it takes to receive that refund from the revenue commissioners. So I think that's a good example to really drill through your circumstance to see if there's merit in pursuing that current year rule for a preliminary tax perspective. Moving on, just on debt management, what we want to stress here, this is not new, this is not related to COVID-19. Current practice in debt management was probably born out of what revenue experienced in 08, 09, 10, where revenue have gone on record as to say we will not be a bank of last resort. Much advancements have been made in this space over the last number of years by way of capturing the number of taxpayers availing of this. You'll see the statistic there in 2019, 6,300 arrangements covering 73 million in debt. The phased payment application process is now online through ROS, very much a welcome move. You can apply 24/7. There's flexibility built in to manage your repayment schedule, also very welcome in the current environment. Just some internal measures to be aware of. There's a requirement for a 25% down payment, or 40% where you require tax clearance. I don't have a difficulty in saying that if you require tax clearance and you haven't got 40%, you really just have to fight your case. Jane has touched on some relaxation of interest provisions, and Carmen will cover the same for in VAT and PAYE. In the space of a phased payment arrangement, there isn't clarity on it at this point. The default position would be that interest would be applied for the periods referred to if you're availing of installment arrangement, but that might change as matters progress. Moving the focus to tax reliefs. What I would say at the outset is the pandemic may offer taxpayers the opportunity to really assess any internal procedures and processes, and some of these may be particular to tax reliefs and credits. What we often find is that the absence of adequate planning or real-time data capture really dilutes taxpayers' ability to get maximum out of credits or allowances that are available. Starting with the research and development tax credit, which is probably one of the most valuable tax credits currently in place, a 25% tax credit on qualifying expenditure with an inbuilt money back formula for taxpayers who cannot absorb that credit against their income. What Revenue have said is during 2020, they will accelerate the early refund of those credits. The legislation was crafted in such a manner that such refunds could not issue until such time as after the return was filed, even where that return was filed early. So a welcome measure here where a taxpayer can access those credits early with an early file. To obtain this, just bear in mind, you have to prompt Revenue to this, and that prompt is made through My Inquiries by selecting it's an R&D refund credit. Equally in the space of tax depreciation and capital allowances, it's fair to say up until recently there was a strong wave of capital investment and capital build. And our message here would be to make sure you're availing of any capital allowance entitlement you have. Typically that involves working through your cost base to see what qualifies as plant and machinery, therefore triggering a capital allowance, which in effect leads to a reduction in tax liabilities and also various offset against other incomes as previously set out. Lastly, just by way of a sum up of that, it's still the revenue commissioners, and by all these measures are welcome. It's just to keep your governance and your books and records, keep that burden high. Lastly, in terms of global measures, we are aware that other jurisdictions have other measures, and given the Deloitte footprint around the world, what we would offer there, if any taxpayer member has any specific queries on that, we would be delighted to assist and offer our insight. So with that, I will pass you on to Carmel, and stay safe.
Thanks, Fergal. So the final section really is I am going to talk around some payroll matters that are very prevalent at the moment, and also some measures that some of us are probably already familiar with to a certain extent as it relates to working from home. And just some final measures as well for consideration, particularly at a shareholder level around alleviating potential cash flow problems. So first of all, I just want to highlight some areas that could ordinarily give rise to risk. And I think the overall theme here is to maintain supporting documentation and backup in the event that down the road, once we have gotten past this COVID crisis, that some queries arise around what strategies were availed of by companies during this time. So first of all, in the areas of tax residencies, the fact that an individual or a number of employees might have been, we say, caught overseas for longer than had been originally anticipated due to travel restrictions can give rise to potential problems for companies vis-a-vis their operations overseas and what that might mean for them from a tax position. So Revenue have confirmed in this area that so long as companies and businesses can show that there was genuine reasons, for example, for employees being based overseas longer than anticipated due to the COVID crisis, that they won't seek to impose tax charges in that regard. I will come back in the next slide on the relaxation of the BIK rules and also on working from home costs. So then moving on to the extension of reporting deadlines for share schemes. So for employers that operate share schemes for their employees, the normal annual reporting deadline is the 31st of March every year. However, as we all know, the 31st of March came in the whirlwind of everything that we're going through at the moment. So with that in mind, Revenue have kindly extended this deadline out from the 31st of March to the 30th of June, which is a welcome measure. And then on that score as well, I would say in relation to foreign employments, Revenue have also indicated that to the extent that employees of, for example, group companies who would ordinarily have been based abroad have come back and are physically based in Ireland for the period of the pandemic, and who might be performing duties for their foreign employer while they are in Ireland, Revenue have confirmed that they won't pursue Irish payroll taxes with regards to those individuals. Again, as I said, the overriding message here is to ensure that appropriate documentation and support is available for down the road should these matters ever come to a point of inquiry from Revenue. Going back then to the relaxation of BIK rules, this was a hot topic in the last number of weeks when we all found ourselves, or a lot of us found ourselves working from home or working under different conditions. So Revenue have provided a number of clarifications in this regard, which are all quite helpful. First of all, they have confirmed that to the extent that people are working from home and they're using employer-provided equipment in their homes, be it hardware, for example, that the use of that equipment will not give rise to a BIK, so there's no obligation for the employer to operate BIK in those circumstances. Secondly, to the extent that the employer may consider it appropriate to have their employees come to and from work in a taxi due to health and safety concerns during the COVID crisis, the cost of providing these taxi fares will not give rise to a BIK obligation. Then in the areas of cars and vans, which is obviously pretty topical at this moment in time, Revenue have given a number of confirmations with regards to different scenarios that could arise. So first of all, where the employer has taken back possession of the car or the van and the employee therefore has no access to it, Revenue have confirmed that there will be no BIK for the employee for that period. If the employee has been able to retain retain the vehicle during the period of the crisis, but has very restricted use of it because of the fact that they're based at home, then no BIK will arise if there's no private use of the vehicle. If private use is allowed and the situation doesn't fall within that of restricted use as just went into above, then the BIK can be based on the January business mileage for January 2020 that individual would have incurred. And the January 2020 mileage then is used as a base for calculating mileage for the months of February to May, for example, or when the restrictions are lifted. Finally, then, I suppose, as would be expected, if the employee is in a position where they can continue to work and carry on their job as normal due to being in an essential role, then normal BIK rules will apply. The other point I'd make in this area is that specifically for the motor industry, where there was, I suppose, reduced cash equivalents for individuals who work in the motor industry and who ordinarily would have discounted rates where they would have the use of company cars, but never for more than never the same car for more than 1 month at a time. Revenue have said that they will relax this condition where an individual may have a company car for longer than that 1 month time frame by virtue of the fact that they are restricted in swapping their vehicles because of these COVID restrictions. So that's a welcome development as well. So finally then, on employer provided accommodation, again similar to the stance taken for taxi fares, employers who provide their employees with accommodation so that they can mitigate the spread of the virus, and for health and safety reasons obviously related to that, and Revenue have also confirmed that no BIK will arise. Another point that has been topical in this whole area of working from home in the last number of weeks has been the possibility where employees might seek to be reimbursed for the cost of doing additional work from home. So for example, there has been some press in relation to this around the fact that employees might be incurring additional costs around the areas of light and heat, for example, while they're working from home on a regular basis. So Revenue have confirmed, in line with the provisions that already existed for e-working, that a daily rate of up to €3.20 can be provided each day by the employer to the employee to compensate them for these additional costs. Just to flag that if they do decide to compensate their employees more than $3.20 a day, then payments in excess of the $3.20 will be taxable. If the employer isn't providing this reimbursement to the employees, then the employees can't seek to claim around some allowance in respect of it. And again, no different to some of the other points I've mentioned already, record keeping is extremely important here in the event that a payroll audit might arise down the road, which would look at this period to substantiate the payments that were made. And just finally on that point, from the employee's perspective, just for them to note that the fact that they are effectively using their home as an office at the moment does not alter their position with regards to capital gains tax down the road if they were to sell their home, and equally it doesn't alter their position with regards to obligations under local property tax. Then looking at other areas for employers to consider around their cash flow, firstly I would say it's a business as usual with regards to filing income tax returns for 2019 at the moment. So particularly for people who think that their 2019 position might give rise to a refund position, I would certainly say you should go ahead and try and compile your information as soon as you can and get your return in, so that if you have a refund due to you, it will get processed and back to you as soon as possible. Equally, if you want certainty around your 2019 position and you think it might give rise to a liability, the fact that you prepare your return and file your return now does not mean that you have to pay the liability early. You still have until the 12th of November next to actually pay that liability. So it does provide some level of certainty for people. Just to comment as well around open appeals and items of revenue, and no different to other businesses, Revenue at the moment are finding that they can't go out on site to do audits. So naturally that's created a bit of capacity in that space around the audit process. So what we would say is that if you have matters that are ongoing with Revenue for some time, then this could be an opportunity to seek to bring those matters further and progress them to see if they can be brought to some kind of conclusion. Then just to turn briefly to the wage subsidy scheme, which has obviously been extremely topical in the last number of weeks. At the moment we're on version 7 of the frequently asked questions in relation to this, which I suppose at one level isn't particularly surprising considering the speed at which this scheme was introduced, given the conditions we were all in, and then the FAQs have been amended week on week pretty much to deal with specific questions that have come in specific circumstances. And I believe even as late as of today, Revenue have come back with additional amendments around circumstances where employees may not have been on the original payroll calculation as at the 15th of March to give some concessionary treatment in that area. So if you happen to have employees in that space who were previously prohibited from availing of the scheme, I would direct you to the Revenue website in that regard, or speak to us afterwards if you've got queries on it. Then to mention the small and medium enterprises, equally to the VAT measures mentioned earlier on, from a payroll perspective, Revenue have confirmed that there will be the suspension of interest in relation to payroll payments for the months of February, March and April. Again, the overriding message from Revenue is to make sure that even though if you may not be in a position to pay or to pay the liabilities for those periods, that the actual returns still continue to be filed. So from a filing perspective at least, the businesses are seen to be compliant. And just to note in that area as well, from an employer cash flow perspective, there are other benefits that can be given to employees which don't attract employer PRSI. So from that perspective, they can represent a saving. So share-based remuneration, those type of awards don't attract employer PRSI, so that's something to be considered. Equally, employer pension contributions won't attract PRSI from an employer perspective. And finally, just to note that the annual gift exemption from an employer to an employee of €500 still stands. And specifically for 2020, Revenue have given a concession related to the COVID-19 measures that if an employer seeks to accelerate part of an individual's reward, which can be up to €500 in the year, by giving them potentially one particular voucher now and maybe another voucher later in the year, then that exemption from payroll taxes will continue to apply. So it's a concession for 2020 only, because normally only one voucher in a year can be given, but for 2020 Revenue have said it can be given more than once, so long as it doesn't go over the €500 limit in total. And finally, just a few, I suppose, larger considerations as well, maybe more from a shareholder perspective, rather than from a day-to-day compliance point of view. Just looking at succession planning, to the extent that businesses or shareholders were looking at potentially transferring shares or other assets from potentially one generation to the next, and this was something that was on the agenda anyway, potentially for the short to medium term, I suppose the COVID situation could give rise to an opportunity whereby share values have been depleted somewhat, or potentially maybe real estate assets have been depleted somewhat. So if a transfer was on the horizon anyway, it may be time to consider going ahead and doing that while the values will be less, and therefore any associated tax charges should be less also. As I say, it's particularly relevant in the scenario where you might have a transfer of assets to family members where no consideration would generally be paid, or at least not market value consideration would be paid, but yet taxes would still arise. And the final point I'd make then, just in relation to that as well, is around liquidity and the timing of payments. To note that if transfers are done at this stage of the year, then the capital gains tax or the capital acquisitions tax in relation to that wouldn't arise for payment until later in the year, being November and December, depending whether it's capital gains tax or capital acquisitions tax. So again, there's the cash flow timing benefit there now to potentially doing some of those transfers now rather than later. So with that, I will hand you back to Karen, who is going to officiate over any questions that have come in. Thank you very much.
Thanks, Carmel, and thanks everyone. So again, yeah, remind that there is a Q&A function if anyone wants to use it at the end of the screen. I might start, Fergal, with you. I know Carmel touched on it around the area of revenue audits. Given, I suppose, this is your area of expertise and you deal with revenue audits on a day-to-day basis, how are existing audits progressing? Are they progressing? Is there still a lot of activity? And I suppose, what's the attitude like in dealing with revenue in the current environment?
Okay, well, first of all, Karen, Revenue have gone to print to say that all visitations on site would cease, and to this point that has been held. Equally, the expectation is there will be no new revenue audits notified. In terms of the current workload, Revenue are working through that caseload. In fairness, any cases that I have, there is an appreciation that timelines may be delayed, and that is coming through in terms of an appreciation that it could be delayed in getting back to them. However, in speaking with Revenue, equally, they are, without the pipeline of new audits, they're anxious for work. So we would look at that as an opportunity to work through the current caseload and look to come to conclusion. I'd layer that up with one other point, that there can be cases which have gathered dust or have been set aside for years, could be in the appeal process, it could be at an impasse with Revenue, and our message to taxpayers and employers there would be, dust them down. There might be a different attitude or a softening of an attitude, but that would be considered on a case-by-case basis.
Okay, thanks, Fergal. That's very helpful. Jane, I suppose turning from you to you just for a couple of minutes, you did go through a whole heap of measures, I suppose, bearing in mind maybe the profile of small and medium-sized businesses that might be sitting on this call. what do you think, I suppose, is the most important thing that someone should look at, or maybe the easiest win?
Thanks, Karen. Well, I guess for a lot of SMEs, the COVID measure that means they don't actually have to pay VAT, and that's been deferred, is a little bit irrelevant because they won't have any VAT to pay. And likewise, with the purchase invoices coming in, there could be a lot less of them now. So now may not be the opportune time to do that. And maybe in a few months' time when you're up trading again, but cash flow is still an issue. And likewise with the sales invoices opportunity. So really, I go to the accounts, the AP review. There can be a lot of VAT tied up in your accounts payable that you may not have deducted in the past, slight errors, etc. And if there's any time within the business, now is probably the time to do that. And as I said, you can go back 4 years, so that there could be significant opportunities there to reclaim VAT. And I guess just to note, if it is a big enough number, it's probably worth, discussing the strategy, maybe not putting into your VAT return depending on quantums, but actually just noting to revenue the reclaim that you're making. And I guess just to add to that we do expect that in 2-3 years down the line, and hopefully COVID is well forgotten by all of us, and it has had pretty little impact, hopefully, at that stage, then revenue can still audit now and what you're doing now. So just make sure that if you are making reclaims for VAT or other taxes, that you've also made sure that you have no payables or no underlying issues.
Okay, thanks. And then lastly, Carmel, I suppose we specifically haven't touched on the wages subsidy scheme, given that was addressed on a previous session. But I suppose in terms of our clients and the conversations we're having on a day-to-day basis, do we see a large uptake or any particular hurdles or issues that people are struggling with on it?
I would say to date the uptake on it has been mixed. A lot of businesses have obviously opted to take it, and particularly where there is no real challenge around whether or not there's been a 25% reduction in the activity in the business. Where we are seeing, though, some level of doubt or some level of, I suppose, additional consideration being given is around the whole area where businesses do have cash reserves. And while revenue have given some guidance and some, I suppose, affirmations around how they foresee the cash reserves playing out, I think some businesses are nervous around that and don't inadvertently want to fall foul of revenue's, I suppose, ultimate interpretation of that, to the extent that they could find themselves having to pay back those amounts. So I suppose to answer your question, Karen, the uptake is mixed.
Okay, no, that's great. So I suppose to keep us on time and to let everyone back to their sunny afternoon, we might wrap up if there's no more questions. But I would stress, feel free to reach out to any one of us individually, and we'll see if we can arrange just to circulate more detail on some of those issues. So with that, I'll thank everyone for their participation today, and thanks to all the speakers. Have a good afternoon and a good weekend, everyone. Thank you.